Well, thank you, Mark, and hello, everyone. Really delighted to be here. Um, Today, I'd like to provide a framework for thinking about the disruptions that are happening in financial and money markets. Um, and so, um, Money performs, we'll start with the basics, which is that money performs three social functions simultaneously. The first is storing value, which satisfies future consumption, and we typically call an asset or a liability equivalently, or a security. The second function is exchanging value, which satisfies current consumption demands, and what we typically call cash or currency. And the third function is measuring value. We use money as an accounting unit, and we typically call that credits and debits. And so you might have heard a story, an economics fable, about where money came from. And Which is that money arose as a result of a barter economy. It's in pre-modern days. It was before money. It was difficult to know how many chickens were equivalent to one cow, right? And so we developed money in order to enable unit pricing. But there's a real problem with this story, which is that there's no real evidence in support of it. If you ask archaeologists and anthropologists, what they tell you is that no society that they've seen ever used barter as the primary mechanism for exchange in their society. Barter did occur sporadically throughout history in many places, but it was never the main distribution mechanism that people relied on. And so instead, what the consensus among this group of scientists is that the first money was likely a credit and a debit, simply a ledger, an accounting unit somewhere. And so up here is what's called the Oshango bone, which is discovered in 1950 in the Belgian Congo. It's a baboon fibula. And what makes it so special is that it has three columns of tally marks running the length of the tool. It's about 20,000 years old. And so this makes it one of the earliest, not the earliest. We have earlier examples of what's called a tally stick, which is now established in later years to have been used as a currency. And so, if tally sticks are currency, well, this pushes the history of money much further back than we had previously assumed. Sorry, my screen's frozen there. And so, what these historical origins tell you is that money is really an information good. It's just an accounting tool. Elon Musk says correctly that money is data, nothing more than bits of information or strings of ones and zeros. And more formally, former Fed Governor Narayana Kocher-Lakota published a seminal paper titled "Money is Memory." And what he shows in this paper is that mathematically, an information storage and communication system is a functionally equivalent substitute to a cash-based system. So money is just an information good. And it follows, therefore, that information technology is really a primary driver in how we all use money. And indeed, some historians believe that writing itself, one of our earliest information technologies, for example, like this cuneiform stone tablet here, writing was invented in order to keep better accounts. And I really hope these historians are right. Working at an accounting firm, it would make me feel good that we know accounting can drive innovation. But stone tablets aren't great mechanisms, and particularly for long distance exchange. And so pre-modern societies innovated by developing tokenized money, which could be carried across distances. And they first used things like mollusk shells before metal ingots and then coinage was developed. But when precious metals went into short supply, new information technologies stepped in to fill the gap, namely paper and printing. And so interestingly, paper currency was first issued by private merchants in Tang Dynasty China. The state took over paper money issuance a few centuries later, and state-backed paper money slowly spread around the world and remains a dominant payment means in many countries still today. But the first digital financial transaction was actually conducted over the US Department of Defense's ARPANET, the precursor to the internet, in 1972. So shortly after this information technology came around, we realized that it could be used for financial purposes. And it was between two students at MIT and Stanford. And since then, what we've had is repeated waves of digitalization have been sweeping through the financial system in the decades since. And now those digital tokens are now increasingly displacing paper. And so what's the point of this history? Why run through this? Well, what it shows us is that cryptocurrencies are decidedly evolutionary rather than revolutionary. None of ledger money, tokenized money, private money, or digital money is new, and three of the four of them are literally ancient. And so today, the information technologies that are disrupting money markets are advances in cryptography, networks, and software. And so, in some sense, the tech has brought us back full circle, really, to the origins of money as simply a record keeping tool. Now, what is new about cryptocurrencies, what is innovative, is that the money is now decentralized and autonomous. And so the ledger is now distributed across a network rather than stored and managed centrally, and that it operates algorithmically, independent of any direct human input. And we'll talk a little bit later about why those features are proving attractive to participants who are adopting these instruments. So the other point that this history highlights is that governments, sometimes slowly and begrudgingly, but eventually do adopt emerging information technologies to improve their money systems. And today we are rapidly accelerating towards CBDCs, or central bank digital currencies. Now, these are conceived as a government-issued, universally accessible, peer-to-peer electronic alternative to physical paper cash. What the concerned policymakers are addressing is that if cash falls further out of favor and demand for cash has weakened due to hygiene fears during the pandemic even further, although it's been on a decline for some time, if there's no demand for cash falls further, then the public won't have access to a direct liability of the central bank. And so what they want to do is offer a digital token that competes with all these new private sector instruments that are coming out. And there are two basic models, and we'll talk about those a little bit later on as well. The first is a wholesale model, which targets a medium of exchange or a payments functionality. And the other is a retail model, which targets a store of value functionality, the two highlighted in gray in the middle of that chart from the Bank for International Settlements there. And so now, because existing financial arrangements have remained pretty stable for a long time, and so no one can really remember when money didn't perform all three of these functions simultaneously. But actually, we have a number of examples throughout history where money was unbundled. And so it's been bundled together for a very long time. But now what we're seeing is instruments being designed specifically for a single use case of money rather than all three at the same time. And this is really a classic startup disruption strategy. You target an incumbent in the sector by going after one part of their existing product bundle. You don't go after the whole portfolio because you can't compete with them at that scale. So you pick apart their offering and offer an improved product or service that goes after that specific market. And so bundling is common in a number of different sectors, but it's particularly common. It's a particularly common strategy in information and technology markets, which are often sold as a package rather than as standalone products. For example, Encyclopedia Britannica or Microsoft Office, and indeed, because money is an information good, these strategies are also readily applicable. And so what we're seeing is money being split apart. Instead of those three roles, we have instruments designed for just one role. And so to explain this and illustrate this unbundling of money, I'll walk you through three recent case studies. So first I'll step through the history of the Bitcoin network and their hard fork from a few years ago. And I'll show how this solution is really an innovation in terms of how central bankers manage the trade-off between these multiple functions. And so this is a problem that every money issuer faces, including modern central bankers and every cryptocurrency token out there. And so we'll begin to understand about money as an asset, but not as a currency, and what that means and what that could look like. The second one is the opposite, money as a currency, but not as an asset. And we'll explore China's recent experiments with digital programmable money, their digital currency electronic payments mechanism. And we'll see that this is a milestone, an international milestone in terms of central banking, because what it does is it enables some new instruments to be designed that could help central banks reach their policy objectives. And the last was we'll look at the Ethereum network and how its ecosystem of decentralized finance, or DeFi, has discovered what makes money a useful accounting unit and why. And so this is an example of money as a unit of account, but not as a currency. And finally, I'll conclude with some points to bring it home to your day-to-day. And so the first case study here is on Bitcoin, which is you can think of money as an asset, Bitcoin acting as an asset, but not as a currency. And so the term cryptocurrency is really a misnomer applied to Bitcoin, whose architecture and governance make it much better suited to storing value rather than exchanging value. And that's because it has a fixed number of tokens released on a preset schedule. And so Bitcoin is designed, it's engineered to be artificially scarce. But when you have a fixed quantity of something, the only adjustment mechanism to shifts in demand is the price. And that leads to exceptionally high price volatility, which is an undesirable feature in a currency, in a medium of exchange. You don't want a bag of carrots to cost 1 Bitcoin on Friday and 5 on Monday. And so as a result of this feature, this artificial scarcity that generates this excessive volatility, the adoption of Bitcoin as a currency, as a medium of exchange, has been practically non-existent. Very, very slow indeed. About 2% of transactions in the Bitcoin network are medium of exchange, current consumption. Now, with that said, at the same time, a fixed supply is an attractive feature in an asset. Think about beach houses in Malibu, or the old Mark Twain quip, buy land because they've stopped making it. When you have a fixed supply, if demand grows, the price must adjust higher. And so to be sure, most interest in Bitcoin is speculative. And demand is rising from retail investors, institutional investors, and hedge funds. And so the point of this story is that Bitcoin in its early days, when it was first introduced, suffered from what a venture capitalist would call poor product market fit, meaning its design satisfied future consumption demands better than current consumption demands, despite being marketed as a currency. And so this poor fit led to conflicts within the Bitcoin network. Some members of the community wanted to make governance changes to meet that threshold of that initial market target to make it useful as a currency. They wanted to raise the block size limit or mint additional tokens, which would make it better suited for exchange purposes. But most of the network resisted, and when no agreement was reached, a breakaway subnetwork implemented what's called a hard fork. And what all that means is they duplicated the underlying blockchain software, including the transaction history up until that point, what was stored on the ledger, and they pushed ahead with a new governance framework to create Bitcoin Cash. So central bankers would recognize this conflict. Up there on the left is British banker and economist Walter Badgat, who identified the very same trade-off facing a money issuer in 1873 after he lived through the banking panic of 1866. What he noted back then was that because money was sometimes used for multiple purposes, it maybe could not do both very well at the same time. And so, for example, during financial crises, when demand for money is very high, whilst firms and households hoard cash, money in fixed supply doesn't circulate very much. That makes it a pretty good store of value, but a really bad medium of exchange. And likewise, during economic expansions, when money is in ample supply and it's circulating widely and rapidly, it's a good medium of exchange, but a pretty lousy store of value. And so former Fed Chair Ben Bernanke actually cited Badgat's dictum, which is the heuristic that Walter Badgat developed about 140 years prior for optimizing this trade-off. How much liquidity should a money issuer inject in the face of rising demand and hoarding incentives? Well, there's no real good solution. It's a trade-off. And so how do you optimize that trade-off? Well, central bankers rely on this heuristic. But the Bitcoin network, facing the same trade-off, devised this alternative technical solution by simply unbundling the two functions. Instead of trading off along the frontier, they simply created a second token that was specifically designed to satisfy this one constituency. So instead of trading off, you push the policy possibilities frontier out. And so up there on the right is the standard way to model a trade-off, usually depicted with guns and butter, your production possibilities frontier. And we can think of financial technology as doing the same thing here. The policy possibilities frontier is shifting out. And so what that means is the trade-offs that have faced central bankers for centuries are being alleviated by some of this technology, and they can now create some new, better targeted instruments that will allow them to regain greater control over growth, employment, and inflation. And so we'll talk about a couple of those policy possibilities next. And so in this case study, we'll think about money as a currency, but not an asset. So the last one, we talked about how Bitcoin is really better designed to be a store of value rather than a medium of exchange. And in this case study, we'll look at the opposite. Money that's really designed to be a medium of exchange, but not a store of value. And to do that, we'll visit China, who's the most advanced country in the world in terms of executing a digital currency. And so the People's Bank of China, the PBOC, is committed to deploying e-money nationwide and recently conducted a series of experiments in major cities to test out its DCEP infrastructure. And so in Shenzhen, residents could apply for a lottery and winners received a digital cash disbursement via a government app. And so this cash, e-money that you won in this lottery, it could not be transferred to your normal bank account, and so it couldn't be saved, and it couldn't be gifted to anyone else. And so it was personalized, targeted directly to you, and it could only actually be spent at a selected number of retailers over a period of 90 days. If you didn't spend it in those 90 days, the money expired. And the reason that they did this is because they wanted to make sure that people actually spent the money so that they tested the infrastructure during the experiment. And so in effect, these balances carry a negative interest rate, right? If you don't spend it, it decays over time. And so spend they did. 95% of the e-money that was allocated was used to purchase goods and services during the test. And so this too is another old idea that's being brought to life again with new technology. And in this case, programmable money, meaning the money had an embedded program and an expiration date, which means it carried a negative interest rate. And so money that decays and expires isn't a very useful store of value. And that means it's almost certain to be spent rather than saved. And in that case, it's a very attractive tool for central banks who are seeking new ways to stimulate economic activity, right? Money that they inject that is sure to be spent is likely to have a higher multiplier, and that means the impact of their liquidity injections can be much greater. And so the idea for such an instrument was actually first proposed by this eccentric fellow up there named Silvio Gesell in the wake of the Great Depression. John Maynard Keynes called him an unduly neglected monetary prophet. And indeed, many of his ideas have been explored by central bankers globally in the last few years. And the reason they're so interested in this idea is because there's a case study that goes with it. A small town in Austria called Würgel decided in 1932 to posthumously implement Gessel's ideas. And what they did is issued a community currency to be used just in their jurisdiction, and that currency lost its value every month. It depreciated by about 1% every single month. And the result was no one hoarded it, no one saved it, they spent it. And it resulted in a rebound in economic activity. Employment increased, growth increased, investment increased, and this was while the rest of the country remained mired in the Great Depression. And so if you think about where central banks are, more than a decade into quantitative easing and interest rates at or indeed below zero in many cases, this suggests that central bankers still have ammunition in order to stimulate the economy. And so China's digital currency electronic payments mechanism shows that these varieties of decaying money are technically feasible, and that's an important international milestone. Central bankers are not out of ammunition yet, and they're going to continue to get more aggressive in the face of additional macroeconomic risks as they materialize. And so expiring money is one simple example of the new instruments that are made possible with programmable money. But more complex programs are possible with smart contracts, and a host of new applications are proliferating within the open source Ethereum ecosystem where smart contracts were first developed. But by far the most popular instruments in this ecosystem are stablecoins, which are a distinct variety of crypto instrument that are pegged one-to-one with fiat state-issued money. The peg is then managed by the private issuing entity, either algorithmically or in the traditional way by holding liquid assets in reserve. And so these stablecoins, the utilization rose very quickly once they were offered. They've stimulated a range of decentralized finance or DeFi applications, and they are now the dominant anchor for a wide variety of this activity. And so what explains the rapid adoption of stablecoins? Well, we can quickly rule a couple things out. The first is that stablecoins' entire objective is to have a fixed price, to stay stable. But that's, of course, not a great feature in an asset whose price ideally you want to be able to rise over time. No price rises, no capital gains. And so stablecoins aren't really a great asset. They're not a great store of value. At the same time, stablecoins are not widely accepted as a means of payment. Few retailers, as far as I know, accept stablecoins in exchange for goods and services. And so they're not very good currencies either. They're not very good mediums of exchange. And what that leaves is the unit of account functionality as the backbone of stablecoin demand. And without question, stability is an attractive feature for the purposes of accounting. And indeed, this is basically why we all coordinate around the same unit of account. Economists theorize that balance sheet risks, interlocking balance sheet risks in the presence of credit chains is why we all adopt the same unit of account. These credit chains arise naturally with advanced forms of economic production because one agent's liability is another agent's asset and vice versa. It's cheaper and easier for everyone to denominate in the same unit. And of course, since the government both issues risk-free debt, their liability is our core asset, the private sector's core asset, and we have a liability to them, our tax liability, which is the government's asset, our balance sheets interlock with them, and so we all denominate in the government's unit of account. But actually, this setup where the accounting unit is the same as the medium of exchange wasn't always the norm. And in fact, in medieval Europe, the unit of account frequently diverged from the medium of exchange. For example, up here is the French livre tournois, which is a unit of account, but not a currency. So all this flourishing activity in decentralized finance is the result of credit chains because they found their unit of account, a stable coin that they can use for some advanced financing activity. But if this activity, including the borrowing and lending of cryptocurrencies for yield farming, if it's driven by interlocking balance sheets and lengthening credit chains, then that means you have systemic risks arising in this ecosystem because materializing risks can spill over from one balance sheet to the next. And so stablecoins, by acting as the unit of account for decentralized finance, are systemically important to the DeFi ecosystem. And unfortunately, there's a couple worrying signs here. The biggest stablecoin, Tether, which is valued at more than 60 billion, and is the third or fourth largest cryptocurrency after Bitcoin and Ether in terms of market cap, they were recently found to have issued unbacked tokens by the New York Attorney General. And additionally, recent academic research published in the prestigious Journal of Finance links this unbacked issuance of digital tokens to significant price changes in the major cryptocurrencies, including Bitcoin and Ether. And indeed, around 2/3 of recent trading volumes in these instruments originate on Tether. So if these instruments are risky, it raises a really important question. Why are people taking so much risk with unproven and unregulated, highly volatile instruments that are frequently issued by poorly governed entities? What's going on here? It's really not hard to understand that this is a risky endeavor. And to be sure, these tokens are often a negative sum game. Every unit of profit paid out must be financed by someone else paying in, net of mining costs. And so the chances that everyone gets rich are essentially zero. The user is exposed to significant counterparty risk. So what gives here? Why are cryptocurrencies emerging now? Well, I think the lesson from history is that private currencies generally emerge during periods of institutional crisis. And so we can see cryptocurrencies as a symptom of institutional decay. And so, for example, what you have up here is a variety of private money that was issued in the 1930s called scrip. It was issued by local banks during federally mandated bank closures. These banks could not access federal liquidity, but they still had customers banging on their door for their cash. And so what they did is created an analog variety of a stablecoin. It's pegged 1-to-1 with state-backed fiat money, and this is from the DeSoto National Bank of Arcadia in Florida. About $1 billion worth of scrip was issued by everyone from school boards and newspapers to wealthy individuals as the supply of cash was tightened. And so during this period of institutional decay, what you see is private issuers filling in, stepping into the gap and providing liquidity. And so if we apply some of these historical lessons to the current situation, to better understand why cryptocurrencies are emerging now, we can turn to this gentleman, who's the head of research at the Bank for International Settlements. His name is Hyun-Sung Shin. He's one of the smartest people on the planet, in my opinion, and he's been studying decentralized consensus mechanisms. So the mechanisms that provide the automation technology for the Bitcoin and Ethereum ledgers, the mechanisms used by these cryptocurrencies. He's been studying these for 30 years, since well before blockchains were even invented, using tools from game theory and economics. And he recently published a paper modeling the welfare benefits of a decentralized financial system relative to a centralized one. And so in what circumstances is it preferable? Is it better for everyone? Or are all our lives improved by adopting a decentralized financial system relative to a centralized one? And what he found is that only when the rule of law and contract enforcement is weak does a decentralized architecture generate higher overall welfare. So this may help explain why cryptocurrencies are so popular in countries like Venezuela, despite their obvious limitations. But it doesn't completely explain why they're being adopted in some developed markets. Um, but it's worth noting that we are coming off the back of a string of high-profile and demonstrable financial crime. We have Bernie Madoff, to the LIBOR scandal, which MIT professor Andrew Lo calls the greatest financial scam in history, an estimated $1 trillion skimmed off the top. We have ISDAFIX, commodity market manipulation, mortgage securities fraud, the Panama Papers. The list goes on and on and on. And in today's world of social media, that information spreads far more easily than in the past. And of course, everyone knows that few people went to jail for these thefts. And so to be sure, we've known there's a problem here, that trust in traditional financial arrangements has been declining for some time. On the left there is the famous book, Where Are the Customers' Yachts? A Good Hard Look at Wall Street, which was first published in 1940 and was republished in 2005 due to overwhelming demand. In the middle there, you have former bank regulator Bill Black, who republished his classic book, The Best Way to Rob a Bank is to Own One, in 2014, after the 2008 financial crisis. And on the right, you have Looting, the Economic Underworld of Bankruptcy for Profit, by two Nobel Prize winners, originally published in 1993, and citations for which increase after every major financial downturn. And so the public has obviously taken note. If you a common theme, if you go and read the white papers for all these crypto tokens, what are they doing? What is their purpose for launching? What goals are they trying to achieve? Well, they often tell you, and what they say, including in the original Bitcoin white paper, is that the purpose of decentralizing the financial architecture is to reduce the need of relying on a trusted third party to review transactions. What they're saying to the traditional financial sector is that we don't trust you. We don't think you have our interests in heart. And so you can think about fintech. The reason that the technology sector is going after the financial sector is A, because it's very lucrative, but B, because they recognize there's a market opportunity given the loss of trust in the incumbent institutions. And so to conclude here, I'll just mention four quick implications. And so if a decentralized financial system is only more attractive to users when the rule of law is weak, then the first step is to strengthen the rule of law in the existing system. And so this is the March 2009 cover of Condé Nast Portfolio, and it says, "Trust, we had it, he stole it," meaning Bernie Sanders. But it wasn't just stolen by Bernie. And so regaining trust is going to prove to be very difficult. And regulators are going to use these new digital instruments, including central bank digital currencies, to promote trust in the system. So how are they going to do that? Well, physical paper cash is very difficult to trace and monitor. Transactions are, of course, anonymous. But digitization ensures far greater transparency than is possible with physical cash. You can trace and monitor cash flows much more easily once it's digital. And what that means is regulators are going to crack down harder on financial crime in the coming years, the goal of which will be to demonstrate to the public that the traditional financial system can be trusted again. It'll be part of a multi-pronged strategy to push back against these private money issuers, including cryptocurrencies, to make sure that they maintain monetary sovereignty, that they have maintained the monopoly over the issuance of money. And this means that there are some growing legal and regulatory liability risks for incumbent financial institutions in the coming years. The second key thing to look out for is rising financial stability risks. And so during the famous Dutch tulip mania, peak prices for some unusual flower bulbs reached more than 5,000 guilders, roughly the same price as an elegant canal house in Amsterdam at the time. And so, of course, these were wildly mispriced relative to one another. But today we actually have a similar situation in crypto markets. On the left up there on the screen is an Ether Rock. It's a non-fungible token, a new variety of crypto instrument, basically a blockchain authenticated JPEG drawing of a rock. And it sold a few weeks ago for more than $1 million. On the right, you have a 6-bedroom luxury villa in George Clooney's neighborhood on the shores of Lake Como, also currently on the market for around $1 million. crypto assets are now collectively worth more than 2 trillion. That's no small chunk of change. And historically, financial stability risks, even in seemingly obscure markets, have a way of spilling over into the traditional financial sector. And so these developments, these new markets, demand close monitoring. The third implication is companies need to start thinking about negative interest rates. And so already about $8 trillion worth of government debt trades at a negative interest rate, mostly in Europe and Japan. And keep in mind that a negative rate means a government earns money by borrowing. It's this topsy-turvy world where you earn money by issuing debt. And so a negative interest rate is in practice a tax on holding low-risk instruments, including cash and sovereign debt. So what happens is government revenue goes up and the private sector surplus goes down. You effectively get charged for demanding safe assets. Now, in the current world, negative rates are bounded only slightly below zero when physical cash is in circulation, when you have paper cash available. And that's because firms and households can arbitrage the rate. If the ECB or the Bank of Japan tried to cut rates any further below minus 50 basis points or 1%, everyone would go to the bank and withdraw cash and stick it under their mattress to avoid the charge. But with no physical paper cash in circulation, by going fully digital, it means that negative rates are unbounded. They can go as low as necessary, minus 10% or more. And so this is both a risk and an opportunity for businesses. Corporations are currently holding about 4 trillion in cash on their balance sheet. Now, all that cash sitting there, in the current world, it doesn't earn much interest, but it earns a little bit of interest. In a negative interest rate scenario, you have that cash creates a liability, an interest rate charge. And so think about what it means for your business if holding cash becomes a liability rather than just as an asset. So that's the risk. You're forced further out the risk curve. You have to pay to hold safe instruments on your balance sheet. Now, at the same time, there's an opportunity here, which is having a very strong balance sheet and operating model. And so there's a former bond trader turned historian named Sidney Homer, who wrote a book called A History of Interest Rates, looking back 5,000 years, bond markets, debt markets for 5,000 years. And what he showed is that during periods of institutional crisis, large companies can actually become pillars of social stability. Some highly creditworthy corporate borrowers are actually able to issue debt at interest rates lower than the sovereign, than the government. And this is quite unusual, as we normally think of government debt as risk-free and corporate debt as having an added credit risk premium. But it's not always the case through history. And so in theory, well-managed and cash-generative businesses could earn income by borrowing, by issuing debt in a world of negative interest rates, by offering people a safe asset that they can hold. And so managers should be thinking about how to position their balance sheets to take advantage of such an opportunity should it arise. And the last one here I want to talk about is growing cyber ransom risk. And so these global digital transactions, anonymized transactions, enable ransomware and other cyber attacks. And so companies are increasingly being targeted with hacks that take control of critical business systems before the attackers demand payment in cryptocurrencies. And so up here on the screen, this is a want ad from the Black Matter ransomware gang. There's an open market for this type of activity, and what they're looking for is employee network credentials, and so that they can begin to infiltrate companies that have more than 100 million in revenue, according to the advertisement. And so, until regulators crack down on these on these crypto markets, you'll see these attacks continuing. And a recent study showed that ransomware gangs prefer to target companies in the U.S., Europe, Australia, and Canada. So there's a couple other risks that could come from this, but I'm conscious of time, so I'll stop there.